To prepare for this week's Disney results, we're going to run some sensitivity analysis using our earnings model. If you're new to our approach, please visit our website, gutenbergresearch.com. You can click this document and it goes through our entire financial modeling and equity valuation approach. And you can also download this Disney model by clicking the free model downloads tab or visiting our blog. We've actually put some notes together for this quarter, some things to look out for this quarter. And below the blog entry, you can download the document. So now let's take a quick look at our model. And there are two main themes that we've kind of heard a lot about over the last couple of quarters, and we think they're going to continue this quarter. The first is on the media side, and it's how the business model is going to look when consumers start to unbundle their cable packages. And we actually got a couple of interesting points on last quarter's call. One was the release of a new direct-to-consumer offering, and that was in the UK called Disney Life. And the other was some talk from management about moving to more subscription video on demand and away from multi-channel video program distributors. So any kind of additional information on what the future business model is going to look like for the cable networks is going to be key and probably going to move shares quite a bit. So that's where we're going to start our sensitivity analysis in the impact on cable networks segment. Before we do that, I just want to point out that our model currently ahead of this quarter's release is calibrated to meet consensus estimates for this quarter as well as the next 12 months. So that's the total revenue and total EPS is matching those consensus estimates as indicated by these orange cells. And the way we build our income statement is by disaggregating the results in this sort of bottoms-up approach, splitting it out between the two media networks. So we have cable networks and broadcasting segment. Then we have the parks and resorts segment, the studio and consumer products, and then finally interactive. And then we have some corporate adjustments that take place each quarter. And each one of those segments has the same metrics. So revenue, quarter-over-quarter revenue growth rates, operating expenses, so operating income, and then we have CapEx and depreciation expectations. So for the time being, we have our cable networks revenue growing at about the guidance that management gave us at the third quarter. So they had guided the total, or I'm sorry, not revenue, operating income. They guided operating income to mid-single digit growth rates from 2013. And we're slightly ahead of that, but pretty much in line. And we needed these growth rates to get back to the consensus revenue estimates anyway. So, but there could be a lot of sensitivity here. You can see that cable networks revenue makes up about a third of the company's total revenue. So if the business model changes significantly, it's going to have a huge impact on earnings and ultimately valuation. So for the time being, we have our year-over-year growth rate in operating income, or let's just stick to the revenue line, at about flat. So we're up about 1.1% year over year. Let's say that this switch from the typical cable bundles to consumer direct product is going to reduce that revenue stream. So let's just say in the first quarter, maybe it's down 5%. And as we do these changes, take a look at what happens to the EPS number on row 36. So let's go from up 12%. Let's actually start slow. So let's go up 10%, down 15, down 5, down 15. So overall, that brought our EPS, so we're now at 548. Let's see what that did to our EPS. We were at 565. So that brought our EPS down about 20 cents, and it brought our price target down about $3 per share. So you can see how sensitive, and I'm going to undo that as we go through here. You can see how sensitive the model is to the cable network's earnings, and that's just on the revenue line. So obviously the operating margin could also contract if you saw a reduction in the total revenue. So that'll definitely be another, this will be another quarter where cable networks is going to be a hot topic. Now let's take a look at the impact of the Star Wars franchise. So we know that Star Wars will continue to be a catalyst for shares over the next 3 years or so, with 2 more movies coming out and then 2 additional spin-offs. And Disney is definitely well positioned to capitalize across multiple platforms, including the studios, the consumer products, and the parks as well. So in our earnings model, we've included the primary Star Wars benefit in the studio segment, and we have 30% growth year over year in revenue and operating income up 33%. So we're estimating they'll be slightly more profitable than they have been in the past as a result of Star Wars. In the consumer products, we actually had, prior to Star Wars, had forecasted a bit of a decline anyway, so we're not really anticipating a huge benefit there, but the parks segment will also have a pretty big benefit. So right now, our model, we've got revenue up 6% year over year, and we have operating income up 11% year over year. And then we also have an additional benefit for parks in 2017, and that's a result of having 1 full year of Shanghai Disney results in that fiscal year. So even with that high growth rate in the studio business, we still were able to get back to the consensus revenue and EPS estimates. So this is probably priced into shares at this point, but if there's any indication that it will be even greater growth rates next year for the studio business, then obviously we could see some big impact on shares. And you might want to just download this model and plug in some assumptions for yourself. So if you think that the studio results for the fourth quarter are going to be much stronger than expectations, then you can do that. You can change this growth rate in revenue. And if you think the operating margin is going to be stronger as well, you might change this, and you can see you're going to add an additional $3 of value to shares just by doing that in the first fiscal quarter of this year. And that's without any additional benefit in the next couple of years. So you could change all these growth rates and see what the impact is. It's a little difficult to analyze Disney because there are so many moving parts and so many different businesses here. But this bottoms-up approach is kind of the best way that you can get to the total earnings in the income statement. So besides the 2 main catalysts that we'll be watching for, we left our other model assumptions pretty much the same. So we have our income tax rate for 2016. We left it at 33%, which is a little lower than 2015. But if we get any additional details on the call this week, we might tweak that. Interest and other income, we've left pretty much the same. So there could be a few tweaks, puts and takes here or there, but nothing too significant. And in regards to repurchases, which is what's driving our diluted share count, if you scroll down below the segment details, we have some ratios where we calculate the change in basic shares and then diluted shares. And then we also have some assumptions for repurchases here. So you can see we haven't changed our assumptions at this point. Management gave us guidance 2 quarters ago that the repurchases would be between $6 and $8 billion, and we are still targeting the midpoint of that range. And we might bring down our share price in that estimate, but for the time being, we're looking at 15 million shares retired each quarter for every quarter in 2016. So for the time being, we'll leave those estimates as is. And then you can see that gets us down to our consensus diluted non-GAAP EPS. And for right now, we've got our non-GAAP equal to our GAAP. So in the fiscal fourth quarter of last year, they did have some non-GAAP charges for restructuring charges. We're not expecting anything significant there, but obviously if we get additional details, we'll plug it into our model. And then we can take a look at our valuation. So we use a tier 1 model for Disney, so that means we're actually modeling on both a multiple valuation and a discounted cash flow valuation, and then we're taking a 50-50 weighting of the 2 approaches for our final valuation. For a market multiple valuation, we're using a next 12-month price-earnings ratio of 17 times, excluding the value of net debt, which we value separately, and that gets us to our price of $92 a share. For our discounted cash flow, we are using a beta of 1.55. We're using an equity market risk premium of 5.1% and a total weighted average cost of capital of 9.2% with a 2% terminal growth rate, and that gets us to our $96 price target. So overall, we think shares are pretty much fairly valued heading into this release. Be sure to check back after the release. We'll update this model and post it to our blog. And if you're interested in financial modeling, be sure to subscribe to our YouTube channel and follow us on Facebook. Thanks for watching.